Continue our last lesson. Today we will define how do we know the timing. Just like a doctor checks blood pressure or body temperature to know if a patient is healthy or sick. We also need to check the vital signs of the economy. These vital signs are called macroeconomic indicators, and the very first one, the most common and the most important, is GDP. What is GDP? GDP stands for Gross Domestic Product. But let's make it simple. GDP is the total value of all goods and services produced in a country during a certain period of time. Think of it as the report card of the economy. If GDP is growing, it means the economy is producing more. People are working, creating wealth, and businesses are making profits. And when that happens, the stock market and property values often grow as well. If GDP is shrinking, it signals slowdown or recession. People may lose jobs, companies earn less, and asset prices often fall or stagnate. So let's keep it simple. If GDP falls or grows too slowly, the economy becomes stagnant. People spend less, businesses struggle to sell, and markets may move sideways or even drop. But when GDP grows steadily for many quarters, that usually signals the economy is entering a growth phase. This is when many financial assets, like stocks and property, have a better chance to rise. Just remember this chain. GDP up will lead to more spending, then lead to stronger businesses. Finally, assets more likely to grow. And the second one you must pay attention to is inflation. Inflation simply means prices rise over time and money loses value. It's about the purchasing power of your money. Real-life examples of inflation. 30 years ago, one house might have cost the same as 50 years of average wages. And today, after 30 years, it's still around 50 years of wages. It looks like people's salaries went up, but their purchasing power did not. Or think about food. If today you buy a hamburger for $2, maybe just a few years later, the same burger costs $4. That's inflation. And no country in today's world can avoid it completely. The healthy range. Now, some inflation is normal. In fact, economists often say that 2% to 4% per year is a healthy range. It means the economy is moving smoothly. Businesses are growing and money is flowing. But if inflation goes too high beyond that, the value of money falls quickly. Even if your salary rises, you still feel poorer because prices rise faster than your income. When this happens, central banks usually step in. They raise interest rates to slow down spending and cool the economy. But inflation that is too low is also dangerous. When prices actually fall over time, we call it deflation. And while it may sound good at first, oh, things are cheaper, in reality, it's a sign of a very weak economy. People stop spending, businesses cut back, and growth can collapse. Don't think danger only comes when prices go up. Even when prices go down, the economy can be in trouble. Why? Because if prices keep falling, companies become afraid to invest. They don't want to produce more goods or services because they fear selling at a lower price later. And consumers also hesitate to spend thinking, why buy today if it will be cheaper tomorrow? This is why deflation is just as dangerous as high inflation. It can freeze the entire economy. How investors see inflation from the investor's point of view. When inflation is high, many people prefer to buy gold to protect their wealth. But when inflation rises too much, central banks raise interest rates. This often puts pressure on stocks and real estate because borrowing becomes more expensive. That's why, as investors, we must watch inflation carefully. It's one of the most important signals in the economy. Now, let's move to the next key indicator, interest rates. Think of interest rates as the price of money. I like to call it the rental fee of money, because when you borrow from the bank, that money is not yours. You are basically renting it, and the interest you pay is the rent cost. It's like renting a car. If you use it, you must pay a fee. With money, it's the same. The fee is called interest. Why interest rates matter? When interest rates are low, borrowing is cheap. People can buy houses and cars more easily. Businesses can borrow money at low cost to expand, invest, and grow. When interest rates are high, borrowing becomes expensive. Consumers cut back on spending, and businesses slow down expansion. This often cools down the economy and can lower asset prices. That's why interest rates are one of the most powerful tools governments use to control the economy. So let's connect it. When interest rates are low, money is cheap. People borrow more, businesses invest more, and the market often heats up. Asset prices like stocks, property, even crypto become easier to rise. But when interest rates are high, borrowing becomes expensive. People and businesses cut back on spending and investment. The market cools down and growth slows. Now let's move to another vital sign of the economy, the unemployment rate. This shows us how many people in the economy want to work but cannot find jobs. If unemployment is high, it means the economy is struggling. Many people don't have income, so consumption drops. When people spend less, businesses sell less. When businesses sell less, profits fall. It's a chain reaction. If unemployment is low, it means most people have jobs. People earn money, they spend more, businesses sell more, and the economy looks strong. The hidden side of low unemployment. At first, you may think, unemployment should always be as low as possible. That's the best, right? But not always. If unemployment stays very low for too long, something interesting happens. Workers start demanding higher salaries. And when wages rise across the whole economy, companies often raise prices to cover the extra cost. This creates inflation. So, low unemployment is generally good, but if it's too low for too long, it can also push inflation higher. So yes, unemployment has two sides. When unemployment is very low, it shows the market is active and strong. That's positive. But it can also lead to rising wages and inflation. On the other hand, when unemployment suddenly rises sharply, that's often a warning sign of recession. It tells us the economy is in trouble. Now, let's move to another very important signal, the exchange rate of a currency. The exchange rate tells us if a currency is strong or weak compared to others. Usually, we compare it to the US dollar or the euro. Example 1, when the local currency weakens. Let's say the Vietnamese dong becomes weaker compared to the USD. What happens? Imported goods become more expensive. People in Vietnam have to spend more local currency to buy the same amount of goods. This pushes prices up, which means inflation increases. Example 2, when the local currency strengthens. Now imagine the dong becomes stronger compared to the dollar. Imported goods become cheaper. People spend less money for the same products. That sounds great, right? But here's the downside. When the dong is stronger, exports become more expensive for other countries. Foreign buyers must pay more of their own money to buy Vietnamese products. This makes it harder for local exporters to compete globally. So just like many things in economics, currency strength has two sides. Weak currency means harder for consumers but can help exporters. Strong currency means good for consumers but can hurt exporters. And remember, companies cannot control exchange rates. They are influenced by big decisions at the government and central bank level. This is why the people who design economic policies for a country must be truly skilled. Because one decision about interest rates, exchange rates, or trade can affect millions of lives. Why exchange rate matters for investors? If you invest in gold, in US dollars, or in assets influenced by currency movements like import-export businesses, the exchange rate is critical. For example, companies that export goods may benefit when the local currency is weak because their products become cheaper overseas. But companies that import raw materials may suffer because they have to pay more. That's why the exchange rate is an indicator we must always monitor. Now let's look at another important measure, the trade balance. This simply tells us, does a country export more than it imports or import more than it exports? Case 1. Exports are bigger than imports, trade surplus. When a country sells more goods abroad than it buys, it has a trade surplus. Money flows into the country. The economy gets stronger support. The local currency often becomes stronger. Foreign exchange reserves grow, giving the government more power to stabilize the economy. This is usually a positive sign. Case 2. Imports are bigger than exports, trade deficit. But if a country imports more than it exports for a long time, it creates a trade deficit. The country spends more money going out than coming in. It becomes more dependent on foreign countries. Exchange rates can weaken. Debt levels may rise to cover the gap. This is a warning sign if it lasts too long. Why this matters to investors. Export-oriented companies usually benefit when the trade balance is strong. Their profits grow and their stock prices often rise. So when you track the trade balance, you're not just reading numbers. You're reading signals about which industries might gain momentum in the stock market. Now let's move to the 7th key macro indicator, budget deficit and public debt. This indicator shows us how much the government spends and how much it owes. Budget deficit, spending more than income. A budget deficit happens when a government spends more than it collects. For example, spending on public investment projects like roads, bridges, and schools. Spending on subsidies or support for citizens. Spending on healthcare, education, and national defense. All of these require money. When spending is greater than tax income, we call it a budget deficit. Public debt, borrowing to cover the gap. To cover this deficit, governments often borrow money. This borrowing is called public debt. Now, debt itself is not always bad. If the debt is reasonable and the money is used for productive projects, the economy can grow strongly. But if the debt becomes too large and poorly managed, it can create big problems, or economic crisis, or high inflation, or loss of confidence from international investors. Why it matters for investors. If a country has strong fiscal policy, meaning clear and responsible management of spending and borrowing, international investors feel confident. Capital flows into the country, foreign exchange reserves rise, and the financial markets become more attractive. But if the country's debt grows out of control, it can scare investors away, weaken the local currency, and even trigger a financial crisis. Fiscal policy is simply the balance between government income, taxes, and government spending. When this balance is clear and well managed, the economy becomes much healthier. So those are the basic indicators of macroeconomics. Don't worry, in the next lessons, we will go deeper into each one step by step. Today's session is just the overview, the map, so you can see where we are heading.